Most investors believe the price of gold is determined by supply and demand, but in early 2026, we've realized that is a dangerous illusion. The global financial system is currently undergoing a structural fracture that is rendering decades of market assumptions obsolete. While you see gold clearing $5,600 and silver challenging $115, the real story isn't the price. It's the violent separation between the digital, paper, market and physical reality. For the last 40 years, we lived in an era of paper dominance. The price of metals wasn't set by people exchanging physical bars, but by digital derivatives and futures contracts. This system functions on a fractional reserve basis, essentially a global game of musical chairs where 350 digital claims exist for every single physical ounce in a vault. As long as investors were happy to settle their trades in US dollars, the music kept playing. But in 2026, the world's central banks have stopped dancing and started lunging for the chairs. This is exactly why the old, buy the dip, strategy is failing. We are witnessing the controlled demolition of the Western exchange model. Look at the Comex in New York. Historically, it's the world's price discovery engine, but it's currently failing under the weight of physical demand. On February 25, 2026, the market provided a chilling example of this breakdown. When silver hit $91.29, the exchange triggered a 90-minute, technical halt. During that blackout, while retail investors were locked out, over 159 million ounces of silver were traded behind the scenes, nearly double the entire physical supply available in the Comex vaults. This wasn't price discovery, it was major institutions washing their losing bets against each other to prevent a total systemic default. This signals a massive shift in how value is perceived. The market is moving from digital promises to physical possession, and the primary driver is the East. There is a loud narrative that China is about to launch a gold-backed, golden yuan, to instantly kill the US dollar. But the macroeconomic data tells a more sophisticated story. While the People's Bank of China has increased its gold reserves for 15 consecutive months, hitting a record $369 billion, they aren't trying to recreate a 1970s-style gold standard. Doing so would force China to run massive trade deficits and lose control over their domestic money printing, two things their economic model won't allow. Instead, China is weaponizing gold as a neutral settlement asset. They are allowing nations like Russia and Saudi Arabia to sell oil in yuan and immediately convert that currency into physical gold on the Shanghai Gold Exchange. They aren't pegging their currency to a rock. They are replacing the utility of the US dollar with the utility of physical metal. This allows them to bypass the Western financial system entirely without opening their capital borders. This shift has created a liquidity mirage in the West. If silver moves past $150, the bullion banks that sold paper promises at $40 will face immediate insolvency. We are looking at a potential delivery default. If sovereign buyers demand the physical metal they are owed and the exchanges can't provide it, the paper market loses all credibility. At that point, the price of physical metal would gap up to whatever the holders demand, completely detaching from the digital ticker on your screen. Nowhere is this physical reality more obvious than in the industrial sector. Silver is no longer just poor man's gold, it has become a critical industrial fuel with no substitute. Over 25% of global silver is now consumed by the solar industry alone. In 2026, demand for high-efficiency panels has outstripped mine production for the sixth straight year. Whether it's AI servers, 5G towers, or electric vehicles, high-tech manufacturers are finding themselves at a physical limit. A semiconductor plant cannot wait for prices to drop. They must secure the metal to keep the lines moving. They will pay $100 or $200 an ounce because the silver is a tiny fraction of their total cost, but the product cannot exist without it. Because 70% of silver is mined only as a byproduct of other metals, miners cannot simply turn on more production to meet this demand. We are not looking at a speculative bubble. We are looking at a violent repricing event driven by sovereign nations cornering the physical supply. The Western financial system has spent decades selling assets it does not possess, and the bill is finally coming due. If you want to master these types of deep dives into the shifting global landscape every week, subscribe and turn on notifications. The era of paper dominance is over. Make sure you understand what's replacing it.